Hello, I'm Georgina Jalbo from Lexis PSL Private Client, and I'm joined today by Dipan Shah, who is a partner at PwC and leads PwC's private client and private business practice in London. And Dipan is here to talk to us about how to plan for the sale of a business. So Dipan, thanks for coming in this afternoon.
You're welcome.
Could you start by just outlining what a family business owner should think about when coming to sell their business?
Sure. I think for a family business owner, this is one of the most important decisions they will make in their life. It's a very important but often neglected decision. It's not something that's part of the day job of the family business owner, and therefore not something that they tend to think about. It's very important for them to think about the eventual disposal, because there are a myriad of issues to consider, not least what will happen to the business when they're not in charge. One perhaps easy way of thinking about what the issues are is to think about the who, the what, the why, and the when of selling. So you start with who would you sell to, actually why would you sell? Mostly the reasons can be boiled down to two things: either personal circumstances such as retirement or ill health, or market conditions, an offer you can't refuse, or a perception that the price is really, really good at the moment but won't last.
Yeah.
Who would you sell to? Internal buyers or external buyers? External are private equity sale, trade sale, floating on the stock market, or an internal sale, which is passing the business to your children. There is a question of, is there someone capable and willing to take that leadership role? Or perhaps passing it to the management team if they can find the funding to buy the business. So there are questions about how much, when will I sell, but in the interest of time I won't go through these. I think the key point to remember is it's really important that the owner thinks about the exit strategy and their objectives well in advance, then they can plan, and to make sure other stakeholders like the minority shareholders, management teams, etc. are all aligned. If their objectives aren't aligned, that friction will often reduce the value on a sale.
Yeah, thank you. And when should a business owner start to think about all of these issues?
As early as possible. Thinking about it typically 6 or 12 months ahead of a sale is simply not early enough. Why do you want it early? As I said earlier, it gives you time to plan ahead. For example, if you want a clean set of financial results for 2 or 3 years before a sale, then you need to be planning 2 or 3 years ahead. Yeah. Planning ahead also gives you time to fix issues if you find them. For example, if you've got a dispute with the tax authorities, it's easy to settle before you go on to sell. Tax consequences are particularly relevant here. I mean, I'd probably go as far as to say there aren't many adverse tax consequences that you couldn't fix, provided you planned ahead.
So, on the subject of tax, what is your number one priority from a tax perspective when advising the owner of a family business who's looking to sell in the near future?
My advice would be use your tax reliefs. The UK government has designed the tax system to reward genuine entrepreneurship and risk-taking. An example is Entrepreneurs Relief, that delivers capital gains at 10% for the sellers of a trading business. To qualify for Entrepreneurs Relief on a share sale, you need to have 5% of the shares, and you need to have been working in the business as an employee or an officer for the last 12 months. Talking about reliefs, there are other reliefs such as pension contributions, research and development credit, capital allowances on capital expenditure. All these reliefs can be claimed, and indeed unused reliefs, you can go back a couple of years and claim them, but you need time to do that. Yeah. And claiming the reliefs generally increases your post-tax profits and hits the value, or rather increases the value you can get on a sale. The other point around tax priorities would be make sure there are no skeletons in your cupboard. It's really important that if there are any historic tax inquiries, these are settled. You see many sales where during the sale process tax disputes of a company come into question, and that normally ends up with a price chip or delays in a sale, or generally professional costs during the sale going up as both sides negotiate an answer. So, most of these are easily avoided if you plan ahead.
Yes. Okay, thank you. That's very clear. Thinking about inheritance tax now, do entrepreneurs have a greater inheritance tax exposure following an exit?
In a nutshell, yes. If you die owning a trading asset, generally speaking, that trading asset is exempt from inheritance tax because it qualifies for what is known as business property relief.
Yes.
If you die owning cash, the proceeds of your sale, the cash usually wouldn't qualify. So on a sale of a limited company shares, value that was IHT exempt immediately becomes inheritance tax exposed. But again, as long as you plan ahead, there are things people can do about their inheritance tax liabilities. Examples are gifting shares in a trading company to their children. That means that the growth in the value post-gifting would be in the children's estate, not the parents' estate. Mm-hmm. So these are just examples that bring out some key principles. Much will depend on the facts of the specific circumstances. But I think whilst on IHT, I guess the other thing adding to it is that most clients should think about having a good will in place, a well validly drafted will in place to ensure that their estate does go to where they want it to go. And people shouldn't overlook life insurance. It's always very handy to have a payout that would help meet your cash outflows at a very difficult time.
Yeah, thank you. Now, there's a lot of activity in the private equity space at the moment. If a private business owner is looking to sell to a private equity house, what should they be thinking about?
Private equity firms will always look closely at the management team that is in place. If the ongoing performance of a business is too reliant on the business owner, the founder, and the private equity buyer perceives the management team to be weak, they will often reflect that in the price they're prepared to pay, or indeed walk away from a sale. So having a really effective and well incentivized management team is important. Another factor to consider is that the owner of the business will often have to reinvest in the business. They will want the owner to have some skin in the game and not just walk away post-sale. Because of these factors, there are often some particular tax considerations to be aware of. In incentivizing management teams, most of their reward can be linked to the equity value of the business. Most of the management incentive structures can be made tax efficient, and one can ensure that they're not a drain on the cash flow of the business, i.e. management get paid out when the founder gets paid out. Mm. It's also important that the proceeds that are reinvested are not taxed at the point they're reinvested, but they're reinvested tax neutrally. All of these issues I'm talking about can be easily managed provided the business owner plans ahead.
And do you have any final piece of advice to a private business owner looking to exit?
Yes, I think it's as simple as thinking, it's as simple as comparing it to selling a house. You want to make sure you find a genuine and committed buyer, and a good corporate finance advisor will help you do that. And you want to make sure that the sale of your house can withstand all the various surveys a buyer will throw at you: structural survey, drain survey, damp survey, etc. So get good advice from someone you trust who's got the necessary skills, experience and networks who can help you. Make sure you recognize that this is a once-in-a-lifetime event, so dedicate the time that it deserves and get the tax right. I would say that I'm a tax advisor, but the difference between getting the tax right and wrong has a big impact on what you take home. Yeah.
Right, well, thank you very much, Dipan. That was a very clear summary of the issues. So you need to plan ahead, allow plenty of time and get good advice because there are many issues to think about.
Thank you.
Thank you.